Hello and welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman, live from our New York City headquarters. The stock rally has resumed for a third straight day. Here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
We're in a market that's evolving very quickly. It's coming kind of via social media, via the commentary coming from the from the exchange, and we've seen a softening of tone over the last couple of weeks. Kind of from the administration, that's helped markets come off of their lows. And then kind of the little bit of pushback that we've gotten overnight has kind of caused a little bit of concern. I think the other thing that's been pretty important is that we've started into earnings season, and I would say broadly speaking, those numbers are coming in better than feared, right?
We were highly impacted on the demand side by the tariffs and then just the consumer confidence erosion. When we started the year in January and had our expectations for the first quarter and the second quarter, since then, the first quarter fell off about 3 full points, and the second quarter has fallen off about 6 full points compared to what we thought in January. So that gives you a good indication of the level of impact on demand and just how rapidly the decrease in demand fell.
We modestly reduced guidance to 2% on the fiscal year for the top line. Our fiscal year ends in a couple months. And 2 to 4% on the bottom line to reflect that approach and that choice, as well as to reflect this fiscal year's impact of tariffs.
We got 1 hour to go until the market closes. I'm joined by Mark Newton today, Fundstrat Global Advisors Managing Director and Global Head of Technical Strategy. He's going to be hanging with me for the show here today. Mark, a friend of the show, it's great to have you here.
Thanks, Drew.
For this today.
Yep.
So just want to run through what we're seeing today in today's action, because we got the Dow now rallying still 427 points, give or take, up about 1%. The S&P 500 up 1.8%. The NASDAQ continues to be the leader here, 2.5%. And, it's interesting because the latest sort of tariff headlines are not necessarily, China came out and said, no, we're not actually talking, but then President Trump came out and said, yes, we are actually talking. But the market seems, less discouraged over the past few days than it had been.
Look, I think the big lesson here is that for those that expect that markets have to work based on what presidential comments are or anything, now know that obviously you can have big moves, with really no resolution for tariffs. And I think that's interesting. Technology has been the biggest gainer the entire week. It's been up more than 5%. So we've had a big move in tech that's led this whole move up off the lows. Breadth, just 2 of the last 10 days have seen advanced decline and also volume hit nearly the highest level we've seen in the last few years. So technically speaking, we could get what they call a Zweig breadth thrust signal based on the work of Marty Zweig. And historically, that's been very, very bullish for stocks in the year to come. The average has been about 35% when this is officially triggered, and it could be triggered actually as of today. So the good news is, the bell did ring at the bottom. We did see very good breadth off those lows. Despite any sort of resolution with tariffs, the market, S&P is breaking out above yesterday's highs, potentially getting up to right near 5,500. I think it's a very, very good move in a short period of time. And eventually, look, we need to have something to really justify can stocks continue. But it's encouraging for those that have been very negative or not sure. And obviously, we see stocks acting really, really well this week.
Yeah, we're going to look more in depth with you at the charts a little bit later on, but we are bumping up against that 5,500 level. And just to illustrate the other point that you were making here about technology leading, here's the 3-day chart of the sectors. So the XLK, the one that you were talking about, is in that pole position, up 9.1%. Consumer discretionary over the 3-day period, up 7.1%. And then communication services, which has overlap with what we think of as tech, right? Up 6.2%. So those are the 3 groups that have outperformed the S&P 500. The only group that's in the red over the period is consumer staples, just for viewers who are watching here. And it has been interesting because we have definitely seen the large cap tech that has been leading here. When you talk about things just being justified in terms of why we might see further upside, could the justification end up being maybe some of these large cap tech earnings as we start to get more of them?
Yeah, I think it's 100% correct. We have Alphabet, of course, after the close. Intel, those are really, really going to be important. The entire Mag 7 is approaching, has started and will continue over the next couple of weeks. This sector is expected to provide about 25% of earnings growth this year in terms of net income. And now it's much more reasonable. It's come down sharply. at a time when everybody is starting to shift money overseas to this whole Sell America theme. All of a sudden now, look what we have. It could be ill-timed. Tech is rallying at precisely the right time. Earnings and the economy very much matter at a time when the soft data has really turned a lot more negative and caused a lot of bearish sentiment. But the market's not paying attention to that. We've seen great progress. I think that's really, really a good sign.
And again here, during this 3-day rally, Tesla up 12.4%, Broadcom up 12.8%, Amazon up 11%, and Google, Alphabet up 7.5% coming into the earnings. So speaking of those earnings, we're going to get more detail on everything going on with technology. We want to start with a report today. Amazon and NVIDIA saying that AI data center demand is not slowing down despite the current economic uncertainty. For more, we want to bring in Yahoo Finance tech editor Dan Halley. This has been a big question in recent days, right? Were we going to start to see that spending adjust on the part of these big companies?
Yeah, this has been something that's kind of gained attention going back for a while now. As you know, there's been talk of Microsoft also pulling back on leases, some reports on that. And so the fear then is that Microsoft, Amazon, maybe Google, the spending just will start to dry up or not necessarily be as abundant as before. Now, we've already seen Google Sundar Pichai reiterate that they're going to spend the amount, the billions that they said they were going to spend this year on AI. And according to these new reports, Amazon not seeing a slowdown, NVIDIA not seeing a slowdown. So the AI spending appears to be intact, and we'll honestly find out more about that as we see big tech spend earnings start to come out, and whether or not there's any kind of slowdown or not. And we'll see it when we start to see more chip action as well, like what the future movement is.
Well, speaking of which, we've got Alphabet after the bell. We've got Intel after the bell also. So obviously one of the things we'll be watching is any update from Alphabet. You know, you said Pichai reiterated. Will he reiterate maybe those CapEx plans? We'll see.
Yeah, I mean, look, the big question there is going to be around Google Cloud Platform and what they're seeing as far as growth. And so the fear is that perhaps there won't be as much growth as people start to pull back. Now, that doesn't necessarily mean it'll happen in this quarter. It's from the different analysts that I've been reading up on and spoken to, it would be a second half, back half of the year kind of impact that we could see if some companies are indeed starting to pull back from their AI spending. That's not the companies themselves, the AI companies themselves, the Googles, Microsofts, the Amazons, but their customers, whether or not they're saying, oh, okay, we're not sure what's going on with the economy right now. The tariffs may be smacking us around. Maybe we just want to get in front of that, so we'll start to pull back some of that spending. The other thing that'll be interesting is ad spending. That's one of the first things that gets cut whenever there's any kind of economic issues going on, and so that could also be an issue. Now, Google is a little more insulated because of the search product. But one of the analysts that I was speaking to had said, look, there's more people starting to use social media to do searching. Obviously, we've seen that before where people use TikTok, but then the AI platforms as well, the OpenAIs, the Perplexities. And, just anecdotally from my own experience, I've been using Perplexity a lot more than Google just because when I want to find something specific, Google seems to lead me astray. Perplexity's been hitting me with good answers.
Interesting.
We know that, look, let me ask you a question. So Google has had a phenomenal track record. It's beaten earnings now for 8 straight quarters. So the fact that all these estimates are being brought down, doesn't that make the bar a lot lower for Google to beat?
It could, obviously. Yeah, I think, it's interesting just because we were talking so much about all of this spending and all of this. Well, Google Cloud Platform's growth has kind of been, I would say, the odd man out, right? Is it going to grow? Is it growing enough? Are we starting to see growth slow down? It's not nearly as big as Microsoft or Amazon. So what would that say if it was slowing? And I think that's going to be the main question, and whether or not they'll continue to see customers pile in. The other big question that's been lurking behind all of the AI talk is, are people getting value out of it? Are companies buying it and then saying, man, this is a great product, or are they buying it and saying, well, this is a cool tech demo? And so, Microsoft, Google, they'll tell you that there's real results from companies, and they'll give you a list of different customers that are enjoying the experience so far, signing on more and more customers. But you need to see from a whole whether or not this is really going to start ramping up their the revenue that they see. And so, it'll be incredibly important for Google to announce some kind of good forward momentum with Google Cloud Platform. And then obviously later on next week, on I believe the 1st is when Microsoft reports. Correct me if I'm wrong. And that'll be just all about the AI movement there, because, yes, they make a lot of money off of Windows, but it's all about the AI and cloud for now.
Right, and all of this will be a good time to focus on the call and figure out what all these companies are going to be saying.
Oh yeah.
Wednesday the 30th, we'll hear from Microsoft. Yes.
Perfect, thank you.
All right, thanks, Dan, appreciate it. Well, big tech leading the way as the stock rally reaches day 3, with investors digesting mixed signals from President Trump and his top advisors on tariffs. For more on the latest moves, let's welcome in Tony Roth, Wilmington Trust CIO. Tony, thank you for being here. I know your team has been hard at work trying to figure out the resting pace of tariffs, I guess, over time. With what we know right now, recognizing that there's still a lot of uncertainty, what is sort of your base case here for what the tariff rate's going to be and the effect on the economy?
Yeah, it's a great question, obviously. So it's a hard one to answer, but our base case is that the tariffs will come down, but they won't come down fast enough, and they won't come down greatly enough in order to preclude the recession that we are now forecasting. And so I think it's very important when we think about the tariff environment that we're in to create a very clear distinction, if you will, or bifurcation of the rest of the world and then China. Because the tariffs on the rest of the world, albeit there are some particular industries like autos, steel, aluminum, et cetera, that have higher tariffs, overall, the rest of the world does not have tariffs at such a high rate that it is tantamount to shutting trade down. But that is exactly what we have with respect to China right now. And indeed, the reason we're seeing the rally is because Scott Bessent, Treasury Secretary, came out and made it clear that the administration recognizes the untenable position that we are now in without having trade with China and the critical role that China places itself in the supply chain. So in order to alleviate that, we're going to need to see these tariffs come down pretty quickly, specifically with respect to China. And if they do, when they do, they probably won't come down fast enough, in our view, to avoid the recession.
Yeah, Tony, I was going to ask you about that. We've heard Bessent talk about, de-escalation after this Trump pivot, so to speak. What's the likelihood that, the hard data does not roll over to join the soft data, and all this negativity about tariffs might prove to be ill-timed, and that we start to see, meaningful pullbacks that happen in the months to come?
Well, I think that the likelihood that the hard data doesn't start to decline is low at this point, because we've seen a big spike in the hard data as a result of forward buying in advance of the tariffs. Now that's going to reverse itself. And we're also going to see a contribution to a deterioration in the hard data due to the many thousands, if not tens of thousands, of small businesses in this country that are being very negatively impacted from a supply chain standpoint due to the embargo that we have on China. And so the administration's put itself in a very untenable position because they have put themselves out there by imposing these unilateral tariffs on the Chinese in a very difficult position where they can't avoid a recession without pulling back on the tariffs. The Chinese are not worried about a recession. And in fact, the Chinese are doing this for the long term. And so our system, unfortunately, does not allow, or fortunately, depending how you look at it, right, does not allow us to be as long viewed and overlook the next, let's call it 6 months to several years. The American people wouldn't stand for an ongoing recession for a long period of time. So we need to move in order to get ourselves into a more tenable position.
And so, Tony, as we've been getting a lot of companies that have been coming out and talking about the potential effect of tariffs, which I guess is not quite hard data because most of it is forward-looking. These are the costs that we expect this year, for example. But as you go through these earnings calls where there's all this talk about it, what is that telling you about where you need to be invested, right? Are you avoiding some of these companies that are very exposed?
Well, absolutely, you should look for companies that are higher quality, which is to say, to some degree, non-cyclical, that have low degrees of leverage, that have high sustainability of earnings in all sectors. And that's what we're doing. But at the same time, you shouldn't be an investor should not be deaf, if you will, to the extreme volatility with respect to which this administration behaves. So we could have Trump come out, before we're done speaking right now, and say, okay, we're going to pull back on Chinese tariffs, and then the markets could rip upwards by a significant amount. And you'd see the more cyclical, growth-oriented tech names, which is what you're seeing today at a much lesser degree, move. So if you're an investor for the long term, so far, our advice is you just stay pat. You ride the volatility up and down. If you have additional cash, you put it to work when we're closer to the lows of the range, which is probably somewhere around 4,800 to around 5,500. We're probably very close to the top of the range right now, unless they make a very major move with respect to the tariffs, specifically on China.
Yeah, my view is look, I think Scott Bessent said yesterday that they expect possible de-escalation. I think both sides are looking for an off-ramp. I mean, the question is, if they're going to start to negotiate, doesn't that mean they have to take tariffs really off the table and grant sort of a 90-day period just to even begin negotiating? And that might take a couple years before that's complete. But when you look at the data in the U.S., yesterday we had great PMI data, the durable goods data today obviously was still pretty robust. And so until we see meaningful evidence of deterioration in the labor market, it might be premature. We might obviously see tariffs be reversed right away. We just never know. That's the whole basis of the art of the deal. And so, I'm just wondering, I guess, how much confidence you have that we are going to go into recession when we know that this whole situation is so chaotic and could very well reverse on a dime, with any sort of negotiation discussion.
Here's what you need to think about. I think, in my view, I've talked about the president as being what I call a cause and effect guy, which is he likes to be the cause of anything that happens, and if he sees the effects, he either lauds himself or he can course correct if the effects are not attractive. Well, right now he's undertaken a lot of cause. He's undertaken a lot of activity in the tariff space, but he doesn't see the effects in his face, which is to say the pain that's being caused for small businesses and even some large businesses across the country. We're seeing a drop in the amount of container traffic that's supposed to be expected to come in the month of April and then even more so in May coming into the West Coast, measured in the tens of thousands of containers. So if you think back to the pandemic, you'll remember that once the supply chains got shut down, it took a long time to get them back up and running again, and that had a lot to do with the inflation that we experienced. So we're starting to see the same phenomenon occur, which is as these supply chains get rerouted, get shut down, as sellers of goods in China start to reroute their goods to Europe and other places, it's going to take a long time to get it back into place. And so it may be pretty quickly here beyond the point of no return as it relates to a recession for the U.S. And I think that if we get to Memorial Day and we don't have a significant de-escalation specifically on China, then we will have a recession, and the question will be how deep and how long will the recession go?
Well, and Tony, just quickly here, before we let you go, we're going to be getting payrolls data next Friday. Anecdotally, I have heard of some tariff-related layoffs, specifically tariff-related layoffs. Is that going to be starting to show up in those numbers?
Yeah, it could. It's always hard for any of the macro data that we look at for any number to tell you all that much because you need to see a pattern, and there's so much noise in the system right now. Having said that, we do look to see companies start to cut back, and you're not seeing it in the high frequency data in the jobless claims yet. They're still at historic lows, but I think that you're going to start to see some more pain in the labor market certainly in the next few months. Whether or not it starts right away, it's hard to know. Companies are still hoarding their labor. Companies don't want to lay people off if they don't have to because of the experience they had coming out of the pandemic. So it may take a little longer for companies, and we're at historic profit margins in terms of the S&P. We have been at least. So they have room to let profit margins come down before they lay off too many people. So we could start to see some of it, but even if we don't see it, it doesn't mean that under the covers, if you will, in small businesses, the pain is not acute. Right. Let me just say to finish, we are a regional bank, M&T, Wilmington Trust. We spend a lot of time in our communities, and we hear every day about companies that can no longer get the things they need to to satisfy their customers, to build their goods, to deliver to their customers. And it's pretty pervasive and pretty existential for a lot of these companies.
Tony, really helpful insight there, especially what you were just talking about. Really appreciate it.
All right, my pleasure.
We're just getting started here on Market Domination. Coming up, shares of IBM falling after earnings results revealed that some of their U.S. government contracts were canceled by DOGE. We'll talk about that stock as well as some of our other top trending tickers later in the hour. And after the closing bell, we'll get you the latest earnings results from Alphabet and more. You can scan the QR code below, by the way, to stay up to the second with all of Alphabet's latest moves. You can also now, this is a new feature on Yahoo Finance, listen in to Alphabet's latest earnings call as well as other earnings calls if you go to their ticker pages. Stay tuned. More Market Domination still to come. The tech-heavy Nasdaq leading market gains as investors digest mixed signals on tariffs. With risks from tariffs hanging overhead and the AI trade under careful examination, tech may be facing a pivotal moment here. Neuberger Berman Managing Director Dan Flax joined us now to discuss. Dan, you're steeped in a lot of these tech names. It's good to see you to talk about what's going on here. I'm going to pose a similar question to you to what we talked about earlier at the top of the show, because we've now been seeing this 3-day rally. Tech has been leading during that rally. Is it sort of anticipation of the earnings we're going to start to get in earnest with Alphabet? And do you think that then is a catalyst potentially for these names to go higher?
What we'll see with Alphabet and some of the other big names next week, such as Microsoft and Amazon, is that they're continuing to execute in terms of on their product cycles. Google with search, Amazon in terms of continuing to redefine the e-commerce experience, more one-day delivery. And so what's important for these companies is that even with the cyclical headwinds, obviously a lot of uncertainty with trade, is that they can innovate, execute, and really drive growth through this period, and more importantly, coming out of this period. And if they're able to do that, I think the market will see that over time, and that could drive outperformance. So we continue to like those names on this market pullback.
Yeah, hey Dan, do you think these companies and stocks have a chance to move back to new all-time highs? And we did see a breakout today in the XLK, which I thought was interesting, getting above the entire downtrend from February. So we've seen a really explosive move out of tech, at a time when tariffs still have not been resolved. So in your mind, does this give this any sort of further, conviction that these companies might be able to deliver, even though we're just starting the earnings period for the Mag 7?
If I look out 12 to 18 months, what I see is that companies, and I'll use NVIDIA as an example, it's not that they're immune from economic cycles, but in their case, for example, they're executing very well on their new platform, which is called Blackwell. So that's ramping. There are obviously headwinds in China, and that will be a factor over the coming months. But the most important thing for NVIDIA is executing on that product cycle, really delivering value to their customers. If you think about artificial intelligence and really the new wave of innovation around generative AI, you have areas that are really getting revolutionized. Think about healthcare as one example in terms of drug discovery, financial services with fraud detection, digital twins with manufacturing. And so NVIDIA really sits at the heart of a lot of this transformation. And so if they're able to continue executing, attracting developers to their ecosystem, I think the stock can be a strong performer looking out over the next couple of years as it creates value for its customers. I think it can create significant value for its shareholders as well.
Of course, in the near term, Dan, that what you're saying about NVIDIA is as true today as it was 6 months ago, as it was a week ago, but all of that has been subsumed by tariff headlines, right, and sort of negativity and pessimism. So I'm curious, is the surge we've seen in the past few days reflective of the AI trade sort of reasserting itself, or what do you think it will take for that to happen in a more sustained fashion?
I think it's a little bit of incremental comfort in the last 72 hours around the tariffs, perhaps a little bit of a pause as the U.S. and China negotiate, as the U.S. negotiates with other countries. And so if the market continues to see that in the very near term, I think it will gravitate towards the names that have attractive growth prospects like an NVIDIA, a Microsoft, an Apple. And so these companies are going to be impacted by the economy and trade policies for sure. But I think the market is trying to see beyond the near term, and it's also trying to see what the new guidelines are. And as the new guidelines come into focus over the next several weeks and months, I think the market will look to companies that can lead from a growth and innovation perspective for the next cycle. I think the market has discounted a lot of weakness. The market assumes the near-term earnings picture will be tougher than it thought 90 days ago. And assuming that the market is correct, the next focus will be, what does it look like coming out of this period? And we look to be positioned in companies that we think can create value coming out of course, what remains a very uncertain period.
Yeah, that's great, Dan. I have a two-part question. One is that, when we look at the antitrust that's starting to happen across the board for big cap tech, it's sort of ironic that this is happening at a time when the competition is probably greater than it's been in 15 years. What's your thinking, first of all, on the whole antitrust, how would that be resolved? And second, what's your favorite part of technology? Do you favor this recent boom in software that we've seen relative to semiconductors, given the underperformance, and also hardware? What's the part of technology you feel should really shine for the remainder of 2025?
So I think that the regulatory overhang is going to remain a challenge for the big technology platforms, including Google and Amazon and Meta. I think these companies need to do more to explain how their business model works. In many cases, if you think about Amazon as one example, they are a platform for businesses to sell around the world. And I think they are adding value to those sellers on one hand and the customers on the other hand, and that is creating value for Amazon and its shareholders. But it and Google and the other digital advertising companies like Meta need to do more to really explain how these businesses work. And so we follow the regulatory dynamics very closely. I expect the lawsuits and the subsequent appeals will be a focus for the next 2 to 3 years and beyond. But these companies have to innovate and grow through that. We've seen with other industries, healthcare is one example, where regulation is really very much a part of the investing landscape, but there's still companies that can thrive despite that. If I shift to the tech landscape, where we see value is in software and some of the digital platforms at current levels. It's not that hardware won't be important. It will be. This in the very near term, it's going to take a little bit of time for some of the implications and the associated costs from tariffs to work themselves out. But if we reflect back on the last 8 years, there's been more trade friction, higher tariffs, and many companies, and I'll use Apple as one example, have been able to thrive during that period despite some of the challenges. Within software, we think Microsoft remains well positioned. Besides their core software business, we think the Azure cloud platform remains very well positioned. The market's concerned in the near term about growth, and Microsoft and the others, including Amazon Web Services, will see an impact from customers moderating spend in pockets. But I think the bigger trend, if I look out 12 to 18 months, is that cloud growth will remain healthy given the innovation that's going on there. And when we speak to customers, they see a lot of potential to expand their businesses on these platforms, which sets a company up like Microsoft and Amazon, for that matter, very well in our view.
Dan, really interesting to hear you say over and over again, 12 to 18 months, trying to look beyond this what's going on right now to returning to the focus on growth for these companies. Thank you so much for your time. Appreciate it.
Thank you.
Coming up, another day of earnings means more guidance cuts and withdrawals from big name companies. We'll get you caught up on the latest when Market Domination returns. Welcome back to Market Domination, sponsored by Tasty Trade. We have been on daily tariff watch this earnings season, so let's round up some of the latest commentary we got from companies. American and Alaska Airlines becoming the latest companies to pull full-year guidance amid economic uncertainty. This following a broader theme across the sector, with multiple airlines scrapping their outlooks because of President Trump's tariffs. We heard from Southwest, for example, as well. And American Airlines CEO saying on the earnings call this morning that economic uncertainty in the market is pressuring travel travel demand, and, quote, given this macro environment, we're withdrawing our full year outlook. Pepsi also feeling the pinch of tariffs. The company reported first quarter earnings this morning. It also cut its full year core earnings forecast. PepsiCo CEO saying in a statement, quote, we expect more volatility and uncertainty, particularly related to global trade developments, which we expect will increase our supply chain costs. And then there's Procter & Gamble expressing similar sentiment about its fiscal year guidance. The CFO saying that the largest tariff impact to its business comes from China, which accounts for just over 10% of its total imports exposure to the U.S. On the earnings call, the CFO also added, quote, the size of the tariff rate makes the cost impact more substantial. So, Mark Newton, I want to bring you back into this as we're here. I mean, just this barrage of companies commenting on this and trying to cope with this. Now, I know you're mostly a technicals guy and a charts guy, but how are the charts sort of telling the story of the uncertainty and what's going on with the tariffs?
Well, we've seen a lot of improvement in the consumer staples group in recent months, simply because there's been so much uncertainty. If I had a nickel for every time I'd heard the word uncertainty in the last few weeks. But yeah, look, I think that the tech has come down sharply. If anything, I think a lot of these staples are actually quite risky compared to owning technology at a very, decent multiple now that most of these stocks have pulled back sharply. And now this week, we've seen technology show the greatest gains we've seen, for the entire week. Tech is up almost, 7-8% for the week. So, I think as a momentum-based, technical analyst, I think that's very encouraging for technology. And now we're starting to see signs of the staples really start to underperform, despite the fact that no real resolution has been heard on the tariffs. So from my perspective, I like tech, and everybody who's in tech, we tend to hear a very optimistic tone about what they're hearing. Those that have to deal with, with China, with other, they're obviously a little more subdued. But for me, that's an interesting opinion.
It is. Let's talk more about China now and its effect on a different business, because with the trade war picking up, Chinese shoppers are actually gravitating more toward local brands. A new report from TD Cowen highlighting that only 9% of those surveyed said foreign brands became more appealing over the past year. That's down 33% compared to 2024. For more, we're bringing in John Kernan, Managing Director of Retail and Consumer Brands at TD Cowen. John, this report could not be better timed, because this is something I've actually been asking a lot of folks that are coming on the show. What is the perception of U.S. brands in China, and are we seeing any kind of this demand erosion? So what's your read through from this survey and the actual sort of sales effect on many of the companies that you cover?
Yes, thanks for having me. Just to level set our survey, our proprietary survey partnered with a Beijing-based advisory who conducted in-person interviews of 2,000 Chinese consumers across a cohort of ages, low to high income, and tier 1 and tier 2, 3 cities. So we covered a good portion of the overall China consumer base. And I think when you look at the survey, 28% of the respondents this year found Western brands less appealing. That's up from 25% last year. So it's a meaningful uptick. The greatest increases in the less appeal response rate, and that was up 450 basis points year over year, was among high-income consumers, and it was also up about the same amount for the 18 to 34-year-old demographic, which is obviously a very important demographic for the Western brands there.
Well, what do you think would make this go away, John? And it's going to take about 2 to 3 years, from what I've heard, to have any sort of meaningful dialogue with the Chinese and try to come to terms with these tariffs. I mean, is there anything we can do to escape a recession, in your view, given your recent what you've learned?
Well, the survey dealt more with China, and I think certainly if the trade war and the tariffs stand where they are now, China would. Our strategists see their GDP growth getting cut in half this year to about 2.5%. I'm fairly optimistic for the U.S. economy. I think there will be trade deals announced, maybe not with China, but we're pretty optimistic on the state of the consumer's balance sheet. If markets stabilize, that's a big boost to the high-income consumer, and 10% of the U.S. population accounts for 50% of total PCE spend. So I think that consumer is in decent shape. Again, confidence has definitely been damaged, but I'm optimistic as we get into year end, there's going to be tariff deals, and the U.S. consumer and the job market will carry us through.
I want to dig into some of the companies that you cover that were covered in this survey also. And by the way, I had not heard of some of these Chinese-based brands, footwear brands, apparel brands, Li Ning, for example. But you talk about Nike in the report, that it's still in the lead, but it has been decreasing in terms of sort of its brand equity and view in China. So for a brand that's already sort of embattled in the US as well, what does this mean for a company like Nike and controlling what it can control? Is there anything that it can do about it?
Sure. Well, I mean, let's start with the fact they're still number one in every footwear and apparel category we surveyed, in most cases by a comfortable amount, but they are definitely losing preference in every single one of those categories. The big share gainers are Li Ning, Anta, and Fila. Fila is actually run by Anta Sports. And those three have been gaining share. They're obviously local brands. They've got localized management teams. They're making better product. Li Ning even sells shoes in the United States now. So, they're still much smaller than Nike in scale, but they are gaining share. Nike didn't lose share to their Western peers in the survey. It was all the share they donated was essentially to the upstart China local brands.
Yeah, I find it really
in terms
interesting.
of what they can do in terms of, I mean, they need better innovation. Clearly they leaned on lifestyle products and maybe streetwear too much. You're starting to see some improvements in their running portfolio, the Pegasus 41, the Vomero, and I think you're going to see much better innovation and much less reliance on the lifestyle-based part of the portfolio.
It seems like most of the survey data that I've heard in recent weeks is so negative across the board. And at what point does the actual hard data really start to roll over to join all this negativity? I mean, you mentioned, survey after survey, it's extraordinarily negative. We know China's in very rough shape. I mean, they have, 3 times the banking system of the U.S., but it's heavily levered to real estate, which is down now 30 to 50%, and their interest rates are at rock bottom. So they're certainly struggling in many ways. The question is, when does the data actually turn negative for the U.S.? To your point, I don't think that necessarily has to happen, right?
Not necessarily. I mean, China, look, the consensus has been negative on China. The consensus on Wall Street has been negative on China, I think, for a long time. This survey we published today probably reconfirms that consensus view. Now, certainly valuations are priced for that. Many of the companies that we cover and have exposure to China are near their 5-year lows in terms of valuation. I mean, it's not just because of China. Obviously, the tariff situation, the overall macro picture, the competitive environment here in the U.S. all plays a role in it. I'm in the camp. Like I said earlier, I'm optimistic on the state of the U.S. consumer. Consumers can say one thing in a survey and then do something completely different when it comes to actually spending their money. Sometimes when consumer confidence is low, it makes people won't feel good, that they'll go out and buy something to make themselves feel better. Generally, the U.S. consumer, in the consumer surveys you see, whether it's the University of Michigan Sentiment Survey or the Conference Board's Consumer Confidence Index, they are always most confident at the top and always most pessimistic at the bottom. So sometimes those surveys can be good contraindicators because they tell you how a consumer is feeling at a point in time, but not necessarily what they're going to do in the future.
Yeah, so on that point, John, hopefully as these companies start to report their actual numbers, we'll catch back up with you and see how the survey has matched what people are actually doing. Thanks so much. Really appreciate it.
Thank you.
Coming up, it's been a wild week for solar stocks amid new tariff announcements. We're joined by an analyst on the other side to tell us the best ways to be positioned in that solar sector. Stick around, much more market domination still to come. As traders digest earnings and mixed signals on tariffs, we're taking a peek at what investors should keep watching. We can't have Mark Newton here and not do a little bit of a deeper dive into the charts. So here we're taking a look at the S&P 500 year to date. We put up a candlestick. You're going to draw a little bit on here to show the trend. I mean, we've seen the last few days the uptick that we have seen. So what are you watching in terms of the
is
trend
what I like to say, the third time's a charm. We have tested this level right near 54.75 about 3 times since April the 9th. That was the day, of course, we saw the big breath explosion. So now we're actually getting over that. So that's actually a very encouraging sign. You also see the entire trend from mid-February also is right around 5,500. 5,500 is a big deal for the S&P. My thinking is that today's move is very encouraging. I mean, the volume has been very good. advanced decline, the breadth has been phenomenal. And I think there's reasons to actually think what's happening now suggests a very good possibility that our spring lows are in place, that it should not be tested again. So even if it's choppy in the near term, and it likely can be without any sort of resolution on tariffs, we have a lot of work to do. Momentum has been very negative throughout this whole thing. We only have about 25% of all stocks above the 200-day moving average. So there is some work to do, but to see technology lead the way it's doing off these lows is really a good sign.
All right, we're going to get to technology in a minute, but I want to touch on something you just mentioned, which is breadth, the number of stocks that are going up versus the number that are going down on each individual day. And you can see pretty clearly on this chart the spikes that we've been seeing, although it's volatile, right? Like you go way up on breadth one day and then you come way down the next day.
Well, this is just the ratio of, say, advancing stocks as a percentage of the total. The ratio got to levels, it happened twice in the last 9 days. They reached the highest level here, has been seen since 2022. That's really encouraging at a time when everybody is so pessimistic about, let's wait till the tariffs end, or we get some clarity, all this uncertainty. Why would I want to invest? Well, the market is sending a sign right now that breadth is really clicking into gear at a time when many are still very pessimistic. So that's a good sign. We saw the percentage of stocks above their 20-day moving averages move from 2%, now it's almost 50% in literally about 2.5 weeks. So investors have to pay attention. Don't always listen for tariffs, ignore the politics, pay attention to what's happening in the market, volume, breadth, sentiment, and specifically technology. It continues to play a leading role heading into these Mag 7 earnings.
Yeah. I want to go to technology specifically here. So I'm, again, going to take a look at the year-to-date. Here's the XLK that we have been watching here and look at a year-to-date for the XLK. So this is the technology spider, the ETF that tracks that tech sector within the S&P 500. And it looks similar to, but not identical to the S&P 500 chart. So that breakout that you talked about, but the breakout here maybe isn't as clear as it is for the SPY. Is it just eyeballing it?
For me, it's actually clearer. I mean, tech obviously dominates the S&P with Apple and NVIDIA, but we see XLK having actually officially broken this entire downtrend. Volume and breadth are very good. We've only had, of course, Tesla thus far. We get Alphabet tonight and Intel. We're heading right into Mag 7 earnings. And so, my thinking is the CapEx spending have really been reaffirmed by Alphabet, by Amazon. That's a good sign at a time when everybody's negative. The sentiment data has turned so pessimistic, but yet these companies are reaffirming it's still going to be a very, very good spot for earnings, I think, this quarter. So I like tech. The fact that it's leading off the bottom after it got hit so hard is a really good sign.
And I am curious, whether we're talking about tech or whether we're talking about the S&P 500. Okay, so the bottom may be in, but what's the range going to be? Because it's not like we're breaking out to new highs.
No, that's a great question, because we're not going to go back to the new highs, anytime soon, in my view. It is going to take some time. So initially, this area between really 5550 and 5600 are really going to be important. I'm skeptical we get over late March highs, which means, you might have a few percent on the upside, and then we probably have to churn a little bit. And then when we see more resolution, at that time, we can start to really make further progress. But there's no guarantee that we're going to go into a recession, in my view. Technically, S&P held exactly where it needed to, 48.35. If you look at the S&P, it is a 50% ratio of the entire move up since 2022, and that's a really, really good sign overall. If we have a weekly chart of that, or going back over the last few years, you can see that we're exactly where we bottomed was a really key point, and really that's a key area. So my anticipation is that is not going to get undercut. Might be choppy, but in general, if you have a long-term perspective, technology is a much better valuation. The earnings, I think, is going to come in just fine, and the tariffs are going to be dicey, but I think we can get through all this.
Great stuff. I'm so glad that we came up here and talked through this. Really appreciate it, Mark. Let's take a closer look now at the solar sector, because the Trump administration has wanted to impose tariffs as high as 3,500% on solar panels from Southeast Asia. We're navigating how to play the solar space with the Yahoo Finance playbook. And joining us now is Maheep Mandloy, Director of Clean Energy Equity Research at Mizuho Americas. And then, Maheep, it's really important how investors are looking within this sort of alternative energy and solar space, because these tariffs will potentially advantage the solar panel makers makers, but it's going to affect different companies in different ways. Let's talk about the panel makers first, what it could mean from them, and whether they're a buy related to these tariffs.
First of all, thank you for having me over here. These tariffs are definitely super high, right? We already seen more than 150% tariffs historically. The same panels cost 11 cents internationally, cost 25, 30 cents in the US. This is before all these tariffs, so those prices will increase. But what's interesting is that because some of these tariffs were anticipated, a lot of the manufacturers have moved out of Southeast Asia to other countries. But the bigger risk now is, what if US imposes tariffs on these other countries, say India, South Korea, or others? So I think that risk still remains over here. I think whenever any imports from any country reach 3% of total module imports, that's when new investigations get triggered. So you could see more of that later this year. So given that backdrop, I think First Solar, which is like the biggest domestic solar module manufacturer in the US, they are the biggest beneficiary of this. So we see some increase in module prices here, still TBD how much it'll be. But modules are only 30% of the cost of a solar system. So the total impact on cost for project developer is not that huge. And there are bigger issues with batteries, which come from China. But I think for solar modules, it's somewhat manageable.
And how many of First Solar's manufacturing of the panels or the modules, how much of that happens in the US?
Sure. So by end of next year, they'll have 20 gigawatts. Of that, 12.5 gigawatts would be in the US, around 3-4 in India, and the rest in Southeast Asia. So they'll still have some tariff exposure to India and Southeast Asia. But the math which we did, like even if you go back to the Liberation Day tariffs on India and Southeast Asia, for First Solar, they still benefit on the US capacity. So we still think there's $4 to $5 of incremental EPS, even if these international facilities are tariffed for them in 26.
Mahip, what are your thoughts about interest rates continuing to come down over the next 3 to 6 months, and that probably providing a more favorable environment for solar in general?
That's a great question. So that's more of a question or risk for the residential solar industry. Where generally most of the home panels are bought on loans or leases. For utility scale, interest rates have been going up. It's not a big issue. I think the bigger issue on utility scale is just the uncertainty with tariffs over here. Having said that, as long as interest rates remain same or come down, that'll still be positive for renewable developers, at least one less thing to worry about.
Well, and in general, tariffs aside, this administration has made very clear that it wants to give advantages to sort of fossil fuels, right? Does that mean disadvantages? Does that mean they're going to be taking away benefits for the solar industry? And what does that mean for your coverage?
Yes, the biggest one which we or investors are looking for is the incentives in the Inflation Reduction Act. So around 30-40%, there's 30-40% subsidy for new solar projects, battery projects, wind projects in the Inflation Reduction Act, and the big estimates out there that the Inflation Reduction Act for renewables could cost $1 trillion. So it's an easy thing to cut and fund other things which Trump or Republicans want here. So that definitely could be at risk over here. If you look at when you talk to investors, they think most likely these incentives will be ended by 2027. We think it could be much faster over here. But even if you remove those incentives, I think stocks like First Solar are already trading as if those incentives don't exist. So I think from a valuation perspective, most of that negative news is baked in over here, and stocks still look pretty attractive at this point, with or without these tax credits.
Mahip, really helpful stuff. Thank you so much. Appreciate it.
Thanks for having me.
Well, we're wrapping up today's Market Domination. Don't go anywhere. We'll get you covered with all the action following the closing bell, including those latest earnings reports from Alphabet, Intel, and more. Stay tuned for Market Domination Overtime.